Can I please ask a question now? It's my understanding
Barbara?
from financial,
Barbara?
excuse me, you guys
We
talked
have
for
Matt
30
and Phil who can probably answer more in-depth technical questions, but
It's
in the
not a
meantime, we're
technical
going to
question, it's a basic question. Can I please ask it?
the last question of the
Thank
press
you.
conference.
And what I understand is from financial institutions, I'm sure you will all correct me if I'm wrong, is that most of these loans are immediately or very quickly resold to other institutions and then resold again and resold again. And if that's the case, what's the point of even sending letters to the initial lenders if in fact now these loans are sort of floating out there who knows where?
That's a point I was trying to make. But Paul is the leading expert on this.
I was going to say, Paul will give you details.
Not the leading lending expert.
No,
Is that the case, first of all? Is that what generally happens?
well, what generally happens is that these loans are made, 60% of these loans are made by non-depository, state-regulated institutions, not your large national banking institutions. The loans are made, as soon as they're made, they're sold to Wall Street firms who then package these loans up and sell them as securities into global capital markets. The lenders, many of whom are on this list, are then basically contracted for by the trustees of the whole securities that are essentially the intermediary between the investors and the lenders. They contract with these lending institutions to be servicing the loans. So they are collecting the money, forwarding the money on to the trustees who then forward it out to all of the investors. The servicers are the ones who have the responsibility for dealing with the customers and establishing and working out these loan modification arrangements.
So they still have the authority?
And they do have
that?
the authority to do that, subject to the terms of their agreements with the investors, of the trusts and the investors who have the rights to the cash flows of these loans. And there are some variations in those pooling and servicing agreements, but by and large, their responsibility is to serve as a fiduciary to the investors to maximize the revenues. And the calculation from an economic perspective is still very simple. Foreclosures are more expensive than modifying the loan and keeping the initial rate, or even in some cases, a lower rate, because you're going to get revenues flowing from the loan as opposed to incurring the much larger costs associated with foreclosures. So these are the right institutions to target. They do have the authority. Sometimes they're subject to some limitations by their investors. It is a complicated world. This is not my mother's mortgage market where you had savings and loans who made all these loans and held them in portfolio, and it was a much simpler transaction process where they could negotiate. But it is a reality that the servicers are on the front line, and in fact today, as I understand it, Treasury Secretary Paulson is meeting with all of the federal bank regulators and a number of the large institutions in Washington, because the pressure is mounting to move towards this larger scale systematic modification approach. And many of these very same institutions at the national level are in these conversations and negotiations.
Thank you, everyone.
Thank you very much.
win.
Thank you.
Thanks. Sure.